In a video earlier this week, I predicted that 5-year fixed rates were going to drop, and needless to say, I was wrong. We're going to talk about that today, and we are also going to talk about Elon Musk's predictions with respect to when the next recession will hit and what you need to do in order to prepare. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, welcome back. Today we are discussing two things. First and foremost, the fact that I was wrong earlier this week when I predicted that 5-year fixed rates would go down fairly soon. And two, we're talking about Elon Musk's predictions with respect to when the next recession will be. And I'm going to give you a little bit of my thoughts on when we can expect the next recession to happen. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. The pace in the last week with respect to new subscribers has been huge. Thank you to all the new subscribers who have joined and those of you who have been with me for quite some time. In order to win that $5,000 that we're going to give away when we get to 25,000 subscribers, you've got to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, it's definitely worth it. Share this video, tell your friends, do everything you can to help me help you by giving away that $5,000. All right, so let's get into the video here. Let's talk about what's going on in the markets this week. Let's talk about how I was wrong with respect to interest rates and the 5-year fixed rates and where they're going to go. And let's talk about what this all means for you. Now, a lot of this today is going to talk about the US economy, but it is hugely important because the US economy is going to have a major impact on how quickly Canada can move its interest rates. And the moves that we're seeing in the US will have a pretty big impact on how quickly the Bank of Canada can move here. So earlier this week, I made a prediction that 5-year fixed rates should come down because bond yields were at a level that they were pretty much not at since October of this year. They were lower than what they were in November and December when 5-year fixed rates were on the rise. So we expected that because bond yields were lower, that we would end up seeing lower 5-year fixed rates coming into early January. And it turns out I was wrong in my prediction. I made those predictions on Tuesday, and on Wednesday, the Federal Reserve Bank in the US released their December meeting minutes, and it shed a whole bunch of light on the market and what you can expect going forward, which had a pretty big impact on bond yields. So let's start by, I'm going to jump into my screen here. I'm going to show you the 5-year Canada bond yield. I'm going to show you basically what happened here over the last 5 days. On Tuesday, when I released the video with respect to interest rates, you can see that we were at about 1.39% with respect to the 5-year Canada bond yield. And as of today, we're at 1.50%. So they have gone up quite substantially in the last couple of days. And the reason for that is, again, that Federal Reserve report that the US put out, their December meeting minutes, that are indicating that they're going to start selling bonds a lot faster than expected. Now, I'll just show you here real quickly the full 3-month chart going back to October. You can see in October, we had pretty low bond yields. They went up in November, December, then they came back down on fears of Omicron. And then this Wednesday Federal Reserve report pretty much put a big spike in bond yields, and that subsequently erases my prediction that 5-year mortgage rates are going to come down. They're probably going to stay pretty similar to what they are right now, at least for the near future. And this just goes to show how quickly economics can change, how quickly predictions can change. It's the things that make surprises in the economy that have a substantial impact on the future of an economy and what it looks like in the next 3, 6, 12 months. So, you know, pretty big thing here. And basically what happened is we had one news report, one press release that changed the forecast for the economy almost instantly. Now, to the same extent that this had a major impact on upward pressure on bond yields, something else could come along in the next week or two and have a pretty significant downward pressure on bond yields. But what I'm going to talk about a little bit is how much the increases in interest rates can have an effect on the economy, or even just the thought processes around increased interest rates can have an impact on the economy. So jumping you in here and taking a look at the headlines on the S&P 500, S&P 500 and NASDAQ fall for a 4th day on spiking rates to cap the first trading week of 2022. So basically what happened here is stock markets across North America were pretty much deflated this week, one of the worst performing weeks since 2021, February of 2021, and also one of the worst first weeks that we've had in recent history. And the reason for this is primarily around expectation with respect to interest rates, because what the Federal Reserve did was they released their December meeting minutes. Those minutes basically said that they were going to increase interest rates faster, or potentially increase interest rates faster. And that had a huge impact on the US and the North American stock markets. And just the thought of the fact that they could increase rates faster had that impact. So basically what we saw is the stock markets dip quite substantially. We saw a slowdown basically in the way investors were operating. That will also lead to a slowdown in the way that people are spending their money and so on and so forth, because as the prospect of higher interest rates gets nearer and nearer and nearer, it's going to change behaviors. It's going to change investing behaviors. It's going to change spending behaviors. And what we could see happen is we could basically see increases in interest rates lead to the next recession as people start to contract their spending almost immediately as interest rates start to go up. So we aren't going to know until we see those first interest rate increases. But when we do see those first interest rate increases, it's going to be very, very, very interesting to see how the markets react. Now, I'll show you the article with respect to the Federal Reserve and their December meeting minutes. Basically, I love CNBC and how they do their articles in this way. The 4 highlights are this. They are ready to aggressively move forward if inflation and jobs reports indicate that that is necessary in the following months. One key aspect of the central bank's balance sheet was the subject of extended discussion, with policymakers pointing to a reduction in bond holdings in the coming months. So in other words, what the Federal Reserve is looking at is reducing the size of their balance sheet. That means selling bonds. Here's how bonds work. When you sell bonds, or when bonds come to market and there's more bonds for sale, that reduces the price of the bonds, and therefore the yields go up. So more bonds available with a lower price means you're going to have higher bond yields, and that's when you see interest rates start to increase. Now, in the opposite way, the reason why bond yields went down so substantially was the Bank of Canada and the Federal Reserve Bank in basically March of 2020 started buying bonds. That meant that they got more expensive because there was more demand for them, and therefore yields went down. So there's an inverse correlation between the price of bonds and their yields. And basically the Federal Reserve saying they're going to get rid of some of their bonds off their balance sheets means that bond yields will go up. Members also expressed concern about inflation and said the job market is nearing full employment. Jerome Powell has been very clear about this. When the market hits full employment, they're going to start increasing interest rates. So it appears that we're getting closer and closer to that. And last but not least, their 4th point here is that stocks slid following the news release. Well, government bond yields rose, and that's what we're seeing with that 5-year Canada bond yield coming up. That is largely due to the fact that the Federal Reserve in the US said that they were going to act faster with respect to rising interest rates. So really interesting seeing how things connect here, how the dots connect, and how one or two individuals in an economy, so Jerome Powell, or in the case I'm going to show you here, Elon Musk, can have a pretty big effect on stocks, the economy, and everything else. And it's all to do with the psychology of the markets. Now, I do want to show you this Elon Musk tweet. It's really, really interesting. So a guy named Christopher Mims, I'm not sure who this is, but he is verified on Twitter. So he must be somebody of some sort of importance. Wall Street Journal tech journalist by the looks of it. He basically put up a chart and it said there are 936 startups valued at more than $1 billion in the world today. What do you think the chart looks like in, say, 5 years? Elon Musk responds to this and says, if history is any guide, not many will make it past the next recession. A guy named Zach comes back and says, when do you think the next recession will be? This is where it gets really interesting. Elon Musk replies, predicting macroeconomics is challenging to say the least. That is for sure. Look at the difference between Tuesday to Friday with respect to bond markets. And he says, my gut feel is maybe around spring or summer of 2022, but not later than 2023. So here is what I am going to take from this tweet that Elon Musk put out. By the way, Elon Musk's tweet had a major impact on the markets. One individual on Twitter in less than 144 characters was able to basically put a pretty big dent in the US stock market almost instantly. But here's the reality of this and what my predictions are and what my thoughts are. And you know what? This isn't so much predictions as it is just thoughts. Is if we start increasing interest rates, when we start increasing interest rates, it very well could lead to the next recession. And I think the reason why Elon Musk is predicting the next recession is because we're basically seeing all of these bubbles. And they really shouldn't be called bubbles because bubbles is just irrational purchasing of assets. I'm not necessarily sure that all of this is what it is, but everything is going up in value. And then we have a Federal Reserve and a Bank of Canada who are very much in the position where it looks like they're going to start increasing interest rates. And those increases in interest rates could cause essentially the next recession. So I think that Elon Musk is looking at end of 2022, early 2023, and saying, okay, that's when interest rates are going to start to go up. It's highly likely that when the Bank of Canada and the Federal Reserve start increasing interest rates, that they're going to overshoot. They're going to raise them too much. It's going to have a major impact on the psychology of the markets. And therefore, we're probably going to end up starting to see interest rates come down again at some point as they try to put more stimulus into the economy to prevent the coming recession that is eventually going to happen somewhere down the road. Now, keep in mind that the pandemic caused a minor recession. And I say minor just from a time perspective and so on and so forth, but it caused a recession that otherwise wouldn't have normally happened. There's still some grounds for there to be further recessions, especially based on the number of debt levels and so on and so forth. I don't think we're out of the woods yet with respect to contracting in the economy. And I think in the next couple of years, I think Elon Musk is probably right. We probably are going to see some other form of contraction or recession in the next few years. And I think it's going to be really interesting to see what happens with respect to what you should do and how you should prepare. I think having money invested right now with inflation is important. I also think having a little bit of cash left is important as well. So when and if prices on stocks and other assets start to go down, you can start to dollar cost average and buy more. And I think it's really important that you get your mortgage strategy right. Now, the big question right now is variable versus fixed. Which should you choose in 2022? I'm not going to answer that on today's video because, quite frankly, we don't have enough time, but I will be answering that on tomorrow's video. Yes, a special Saturday video for my regular viewers. And we're going to talk about variable versus fixed in 2022 and how you should go about making the decision between a fixed versus variable interest rate. And I think the answer is going to be quite surprising because, again, it's not necessarily to do with the direction of rates, but the fundamentals of the decision that you're making. So, by the way, if you're interested in that question of variable versus fixed, and if you're in the market for a mortgage in the near future, we do have our Secrets to Getting the Lowest Interest Rate course available once again. It is priced at a pretty huge discount because my mission is to have at least 1,000 people go through that course this year. We almost got to 1,000 last year, but we didn't quite get there. So I want to get over that 1,000 person number. That course is designed to teach you how to negotiate with a broker, negotiate with a bank, understand how much margin there is to negotiate, what sort of things you can get added into the mortgage, what other costs can get lumped into the mortgage, and so on and so forth, and basically how to make you the most informed mortgage borrower out there. By the way, we also discuss a lot the difference between discount and non-discount interest rates. That chapter alone is worth its weight in gold because it will help make sure that you don't make any sort of mistakes with respect to choosing your mortgage, especially things that can cost you $5,000, $10,000, $15,000, $20,000 down the road that you definitely didn't expect when you got that ultra low interest rate. So if you want that course, link in the description below or go to ratesecrets.ca. Watch out for that video tomorrow and make sure you're subscribed, turn your notification bells on, and you'll be one of the first to see that video. And don't forget about that race to 25,000 subscribers. Again, we'll see you tomorrow on the very next video. Cheers.